In this week's video, we'll review the latest charts and data to help us answer the question, are new highs coming in the stock market? Let's kick things off with a mega cap leader from the semiconductor and AI segment of the market. Thus far, it's a good sign that NVIDIA made a stand at the anchored volume weighted average price line tied to the end of 2023 here. That's the pinkish line. You can see price came back on the daily chart, tagged it. It's also a good sign that if we take the same concepts, an anchored volume weighted average price line, tie it to the closing high here, we gapped above that level on the daily chart on Friday, May 3rd. Like the bigger concepts from last week's video, so far so good. Still has some work to do, but it's made significant progress relative to this low here. When the S&P 500 dropped 80 points on Tuesday of this week, we knew that we had a monthly labor report, or NFP, coming on Friday, and thankfully it was a market-friendly report. You can see sector performance down here during Friday's session. The only red sector, inflation-friendly energy, the market leader, XLK, or information technology. So risk-on, risk-off ratio that we've covered in recent videos, tech sector XLK relative to defensive-oriented 1 to 3 year treasuries SHY. Again, falls into the so far so good category. It's good to see this thin dotted line here tied to the Q4 low for the ratio in 2023. We undercut that anchored volume weighted average price line twice recently here, and here we have somewhat of a W formation, and we're back above it. That would be the so far so good. We'd like to recapture the same anchored volume weighted average price line, the thin one here, shown in pink, same concepts, tied to the end of 2023. And we'd like this look here relative to the moving averages, a 50-day moving average in green. This is the 21-day moving average in blue. We'd like this look here to look a little bit more like early November of last year. Last year's correction saw the ratio make a stand at an upward sloping 185-day moving average shown in black. So far, the ratio remains above an upward sloping 185-day. Now let's shift gears to another very important mega cap. And it's important if you own any S&P 500 related ETF, VU or SPY. It's important if you own a growth-oriented ETF like SCHG. And the same can be said for the tech sector ETF XLK. This is an understandably busy chart, but we'll walk through it slowly. We've covered these concepts numerous times. This is Apple. It's a daily chart. This is the anchored volume weighted average price line shown in green tied to the COVID low in 2020. It was a good sign that the 2022 low for Apple held at that green line. Also a good sign that the recent pullback held here at the orange anchored volume weighted average price line tied to this 2022 high. This is a logical place to hold. This is a logical place to hold. During Friday's session, we also recaptured the anchored volume weighted average price line tied to the July 2023 high and a similar line tied to the December 2023 high. And we're back above the anchored volume weighted average price line tied to the October 2023 low. This is a very important intermediate term region here where my cursor is. This is a very important intermediate term region down here, this one being more important relative to the bearish case. If price moved into this area here, it would be below numerous and important anchored volume weighted average price lines, and that would favor bearish probabilities. It's also true that when you're back above those lines, it favors bullish probabilities. Longer above, the more relevant it becomes. When we look at this chart here and the movement in recent sessions, it aligns nicely with the headlines from Friday. Similar concepts here, S&P 500 SPY ETF weekly anchored volume weighted average price line tied to the Q4 low in 2022. It was a good sign that we made a stand at that exact same line in Q4 of 2023. And that marked the end of this 10%-ish type correction in the S&P 500. If we are going to have a strong trend year, meaning when we get to the end of the year that the maximum S&P 500 drawdown is relatively muted, let's say capped at 6%, we would most likely expect SPY to hold these anchored volume weighted average price lines here, tied to the end of 2023 here and very early in 2024 here. So far, we've had a short stay below. We've come back to both lines and at least bounced. Again, so far so good. Longer above, the more relevant it becomes. If these lines don't hold, then our reference points become the red line, the blue line, and the orange line. The fact that we're above the red line tells us that the rally from the Q4 2023 low is still intact, and the fact that we're above these two lines here tells us that the year-to-date rally, or the year-to-date trend, is still intact. All things being equal, it's a good sign that the S&P 500 bounced here at an upward sloping 20-week moving average. You can see during the bear market in 2022, it had a very difficult time every time it approached a downward sloping 20-week in blue. We've talked about this ratio before, shorting 20-year U.S. Treasury bonds. So think the double inverse of TLT in the ETF world. This ratio is relevant because when market participants are concerned about inflation, especially long-term inflation as they were in 2022, you don't want to own long-term U.S. government bonds because they have a difficult time keeping up with inflation and they tend to swing wildly to changes in interest rates. Hence, why this ratio went up sharply during the bear market in 2022 when market participants were concerned about inflation. You can see since then, we've made a lower high right here. This is a lower high relative to this high, and a lower low. These are lower lows in here relative to this low here. If you're a stock market bear, you'd like to see inflation take off, you'd really like to see this ratio move into this area here. If you're a stock market bull, you would like to see another lower low below these lows. So far, this region in here that you would expect to act as resistance is acting as resistance. We'll see how it unfolds. Another inflation-oriented ratio that we've covered numerous times. We've covered the concepts numerous times, so we will move quickly. Energy, XLE, relative to XLK, the tech sector ETF. This is the fear of inflation look here. This is calendar year 2022 in this region here. This is where inflation concerns start to subside. This ratio, too, is making a series of lower highs and lower lows. And so far, this move from point A here to point B here looks corrective in nature, similar to the period in here when the S&P 500 had a normal correction in Q4 of 2023. This really doesn't look anything like this massive spike here in 2022. Another chart, so far so good, but it has some work to do. We would feel better about the current rally attempt if this ratio moved into this region here. At the present time, if there's one chart to watch, to monitor concerns about inflation and concerns about the probability of another bear market rearing its ugly head, this anchored volume weighted average price chart of small caps IWM may be that chart. We've covered it numerous times. It still has a look similar to the look of the S&P 500 or SPY around mid-May of 2023. And you may remember in mid-May of 2023, there were numerous bullish signals that were starting to emerge, aligning with the theory that this chart unequivocally tells us to keep an open mind about much better than expected long-term outcomes. It still has work to do. It needs to make a higher high, and it needs to establish a clear uptrend above this region here. It has not done so yet. Thus, the so far so good. And again, the reason why you have so many lines on the chart, so many anchored volume weighted average price lines, you're trying to find a region that could act as potential resistance, as it did here, as it did here, and as it did eventually here. Now those same lines appear to be acting as support. So we're consolidating above all of these tight clustered lines in here in a similar manner to what the S&P 500 was doing in the first half of 2023. And that did resolve in a bullish manner. During Friday's session, we're back above the anchored volume weighted average price line tied to the recent high. We're also back above the anchored volume weighted average price line tied to this high and tied to this low here. On a shorter term basis, very important region in here. And in terms of increasing bearish probabilities, if IWM moves into this region here, that would not be something the bulls want to see. It's also noteworthy that the current rally began when IWM made a stand at this red anchored volume weighted average price line tied to the Q4 2016 low, or the election low. When we tagged that line and went on to make a higher high, things started to look different relative to this region in here. Here's a zoomed in version, makes it a little easier to see. Holding at the Q4 2016 anchored volume weighted average price line, recapturing the line tied to the 2021 high, and making a stand at the anchored volume weighted average price line tied to the Q4 2023 low, and now exceeding all three lines tied to this high, and this low. Longer above, more relevant it becomes. While I keep an open mind about better than expected outcomes in small caps, look here. From a weighting perspective, IWM on a daily chart, still clearly in a downtrend relative to SPY or the S&P 500. This is the downward sloping 250-day moving average in black. Everything that we just said about the last chart also applies to IWM relative to XLK, shown on your screen. And we never want to get overly wound up or confused by relative charts. Relative charts help us with weightings. Charts in isolation help us with bull-bear trends. And as we mentioned last week, during the recent volatility, all of the price action on all of these charts, SPY, RSP, SCHG, XLK, IWM, and the MYSE composite in the lower right-hand corner, all of this volatility up here has occurred above an upward sloping 250-day moving average in black, and that concept applies to all 6 charts shown on your screen, telling us to try to remain patient within the context of what appears to be 100% normal and to be expected volatility that occurs within the context of any bullish trend. The TBT XLK ratio and the XLE XLK ratio help us monitor concerns about inflation, especially from a long-term perspective. We can do the same thing using the small cap chart in isolation, and similar concepts apply to the NASDAQ composite relative to the S&P 500. And you can see this is IWM over here on the right side of your screen. A lot of similarities with the consolidation in here. It's also similar that we've failed or have yet to complete a higher high above this high. The same can be said relative to these highs up here in the NASDAQ S&P 500 ratio. This is early 2024. The concepts on this chart, this is bullish, this would be bearish, applies to this chart as well. This also has a so far so good look, making a stand above this mustard colored line tied to where the rally originally began in late 2022, early 2023. If we zoom in on this region here in early 2024, it may be noteworthy that this short stay look here, which is right here on the larger chart, if we can go on to exceed this high, the fact that we're above these anchored volume weighted average price lines on the ratio here from earlier in 2024, if we can hold above it and exceed this high, that would be good for bullish probabilities. This is simply a zoomed in version of this region here, this chart. Here's an example of how anchored volume weighted average price lines can be extremely helpful. Red line tied to the 2021 high for the NASDAQ Composite. Light blue line tied to the late 2022 low. You can see the correction in 2023 ended at the intersection of those two lines. Red line comes in here, light blue line comes in here. It was also noteworthy when we exceeded the anchored volume weighted average price line tied to this high here. When you exceed it and move like this, the odds of the correction being over are higher. In a very similar manner to everything that we just talked about, especially holding at the red line and the light blue line, we're doing something similar so far. So far, so good. The NASDAQ came back, rallying at a very logical level. It held at the anchored volume weighted average price line tied to the October 2023 low. Still have some trend work to do to be more confident that this pullback is over. So we have to keep an open mind about additional downside. If we zoom in here, during Friday's session, we were above the anchored volume weighted average price lines tied to this high and this high, which is here and here on the larger chart. Longer above, more meaningful it becomes. This is a battleground in here for the NASDAQ. Above it, we feel more confident that the correction or corrective activity is potentially over. Below this line down here, we feel less confident that the rally off the October 2023 low is still intact. Now let's shift gears to an update on the secular volatility research, bullet points in the lower left-hand corner of your screen. We continue to make progress, but let's take some time to remind ourselves how all of this can be helpful and why it's so important for us to monitor the health of very long-term stock market trends. Lower left-hand corner of your screen, 1950. When I go from 1950 to the end of 1968 here, I'm highlighting the strongest portion of a secular trend window. Lasted approximately 18 years, and you can see between point A and point B, over time there are signs that the trend is weakening. Probably fair to make an argument that this low here in 1953 looks significantly different relative to this low here in 1974. And as we walk forward from point A to point B, the trend gets weaker, and hence the markets tend to be riskier and the drawdowns tend to be greater. In a nutshell, when the data that we have in front of us regarding the secular trend, when that data is strong, we treat this type of pullback differently from this type of pullback and this type of pullback. And when the market's in an uptrend and relative to our cost basis, things are looking good, things are profitable, it's worth reminding ourselves how painful a drawdown like this can be. Nobody, especially somebody between the ages of, let's say, 50 and 90 years old, wants to see their $10 million experience a 48% drawdown and see their $10 million turn into $5.2 million. Nobody wants to see their $500,000 turn into $260,000. And conceptually, and from a probability perspective, that's where the secular volatility model can help us. This is one example. This is one of many charts covered by the secular volatility model, but it can help us illustrate basic concepts. As this trend is weakening, the charts and the visual evidence and the hard data, they start to do things that they haven't done before in a manner that we haven't seen before, and they speak to the increasing probabilities relative to painful drawdowns. So from an anecdotal perspective, fair to ask and answer, how does the exact same chart look today? Concerns would increase if we had a look like this or a look like this, where price drops below the Bollinger Bands and the Bollinger Bands start to roll over. Prices below, Bollinger Bands are rolling over. It's not what we have today. We have a little bit of a stalled look in the exact same Bollinger Bands, and we had a short stay below the same bands. And now the bands look like they're trying to turn back up in a bullish manner. Slope up, slope up, slope up, price above. Slope down, slope down, slope down, price below. slope rolling over, slope rolling over, slope rolling over, price below. It's another chart used by the secular volatility model. There's nothing magical about the previous chart nor this chart. It's the weight of the evidence that's useful. You can see for the most part, between 1989 and the year 2000, price makes a stand above or near these Bollinger Bands. And when that changes here in Q4 of the year 2000, it's helpful, because after this look here, really bad things happened. This really doesn't look anything like this strong trend period in here in the 1990s. And that's helpful because this too was approximately a 50% drawdown, meaning it's another example in history where this table or the concepts presented on this table would apply. When we examined this chart in January of this year, did it look like this? It did not. It looked like it was trying to improve. How does the chart look today? Is it starting to take on this deterioration type look in here that's concerning in late 2000, early 2001? It is not. It also has a short stay look. Really, one monthly close below is all you could get. In this case, you were below, but then you closed back above, below, above, below, above. Doesn't look like we even got 2 consecutive monthly closes below the Bollinger Bands. Now the bands are trying to turn up. They have turned up, slope up, slope up, slope up. Price above as of May 3rd intraday. This turning up look with price recapturing the Bollinger Bands, almost the polar opposite of this look in here. And that tells you something about bull-bear probabilities. And that tells us something about how we should allocate our hard-earned capital. Similar concepts here, different charts, different parameters. These are moving average envelopes. They're monthly charts. Things look pretty good here in 2000, pretty good here in 2007, and pretty good here in 2021. And then there was a discernibly different look here in the year 2000, a discernibly different look here late in 2007, and a discernibly different look here in 2022. If you're going to use an indicator or input to help you assess bearish probabilities, those same inputs should help you assess bullish probabilities. And you can see here in 2003, things start to look discernibly different relative to the bear market. Here in 2009, things start to look discernibly different. We can see this, measure it, put it in a model relative to this look here during the financial crisis. Same thing happened in the transition year in 2023. It takes some time for this chart to transition. It looked even better as of January 11th, 2024. We covered these charts in the January 12th video. How does the same chart look today? Better, worse, or about the same? Or, more importantly, is it starting to look like this, or is it starting to look like this? The answer is no. Again, we almost have the mirror image, a turning up look relative to a turning down look, a turning up look relative to a turning down look. Chart on the right side of your screen dated May 3rd, 2024. Nothing magical about these charts either, but again, they can be useful when used in a weight of the evidence manner. So now looking at 1958 into 1974 on the right side of the screen, the secular volatility model helps us understand whether we look more like the left side of the screen, healthy secular trend where the odds of making higher highs eventually are favorable, or the right side of the screen, the red box. Here's the same red box here. The model also helps us discern between the blue boxes and the orange boxes, the strong portions of the secular trend where the odds are favorable for the most part on all time frames, and the orange boxes where you experience drawdowns or normal counter trend moves within the context of a secular uptrend. Scores that we covered in January, very favorable. Have they shifted in any material manner? They have not. Scores look very, very similar on May 3rd, 2024, telling us we really don't look anything like this red box here, and the odds say we look more like a blue box relative to an orange box. And as we've done in the past, we can take these concepts, a secular trend concept, and overlay demographics. The secular volatility scores tell us that the data that we have in hand tends to align with rather than contradict the secular trend thesis. It's also noteworthy that fundamental data that we're seeing also aligns with the secular trend thesis, a secular trend driven by favorable and improving demographics, millennials, Gen Z, add in AI. All of the topics here that we've talked about in detail in the past and cover in detail in this post that you can find on our website by Googling the title on your screen. All of that aligns with present-day fundamentals. Article dated May 2nd, 2024. Don't feel too sorry for Gen Z. They're outpacing boomers on income and millennials on home ownership. April 29th, article here from the AP that a client was nice enough to forward to us, something we appreciate. What is this article talking about? It's talking about this concept right here, that we're in a different world where many retirees, due to their RMDs, 401ks, IRAs, rather than becoming a drag on the economy, many of them are taking money out of their retirement accounts, and you're forced to with an RMD. They're stimulative. They're stimulating the economy. Another article dated April 4th, 2024 talks about prime age employment, which is exactly what this table is about up here in the center of your screen. It's exactly what this table is about. This table and this post here, lower left-hand corner of your screen. Thus, the data that we have in hand today, and that's the key, the data we have in hand today tells us to try to keep an open mind about much better than expected long-term outcomes. If the secular trend is positive, by definition, any volatility will eventually resolve to the upside. If that's not the case, then it's not a secular bullish trend. Thus, keeping these concepts in mind and the scores shown on your screen, including these trend strength scores, CCM market model scores, and keeping in mind that even if we're in a secular trend, drawdowns between a point A and a point B can be significant, something we have to prepare for, something we are prepared for. But right now, the data that we have in front of us is allowing us to think long term. If the weight of the evidence changes, we'll have to reassess those probabilities. And these concepts and these scores here, especially the scores, they help us trade the chart in front of us, trade the data in front of us, and they make sure that we don't fall in love with the secular trend thesis, and we don't fall in love with the demographic thesis. We have a way to monitor it, and we have a way to make adjustments if the data starts to drift from that thesis. And we all know, if we're going to use all of this effectively, it's incredibly important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.